Hi, everybody. How you doing?
How's it
Doing
going,
good.
Katie?
It's going good.
Afternoon.
Can't believe it's July already. Where is like the time gone? I don't know.
Yeah, I feel like that's the most common phrase that I say. Man, where does the time go?
Yeah.
It just keeps going and waits for no man.
Wait.
Hey, you never seem to find the things to do, the things that you wanted to until you find them.
Well, that's true.
That's Jim
Very,
Crow.
very insightful of you. Very insightful. Well, good. Well, welcome everyone to our third webinar of the year, coming in hot. My name's Katie Brown. I'm the managing partner here at Armstrong Dixon, and we're so excited to have some of the familiar faces on today. We're hoping you're having a great summer so far too. We're excited to talk to you today about current events, planning, tax topics, etc., anything you name it. As a reminder, we welcome any and all feedback and most definitely questions as they pop up. So just shoot me an email if you have anything. My email is kbrown@armstrongdixon.com. I'll be monitoring throughout, so if you see me kind of managing, I'm just responding over here. We'll do our best to answer them, though, anonymously throughout. And if you have any connectivity issues, we just recommend exiting the webinar to then come back in fully. And if you still have tech issues, shoot me an email too. On today's panel, we have Greg, Skylar, and Nav, all CFP professionals at our firm here to help serve your families. And I think today's a really interesting day to have a webinar, right? We have the Fed Chair, Jerome Powell, testifying about interest rates today. So it's pretty wild. What do you guys make of everything?
Well, it's going to be interesting to see what unfolds. Rates were hiked at the most aggressive pace than we've seen in 40 years back in 2022. And there have been a number of forecasts for any certain number of cuts that were expected in 2024, but we have yet to see any. And we are still unsure, and they're not saying specifically what they're going to do, but they are kind of forecasting, or at least intimating what their thought process is. And essentially, they rose interest rates to kind of slow the economy a bit. And once it reaches a level at which over a certain number of metrics, unemployment, inflation, housing prices, they're trying to not pull us into a full recession and are hoping for this soft landing for the economy. So they want to slow it just enough so to calm the inflationary pressures to keep costs down for everyone. And so unemployment numbers came out, and they are at 4.1%, which is really low, historically, but it's a little bit higher than what it was at 3.7%. And they're really trying to target like a 5.25% unemployment rate. So as they look at everything and make decisions, we'll likely find out later in this year if there is going to be a cut or if it's going to be pushed off into 2025. Whether there's a cut or not, so long as there's not another rate hike, things are looking very constructive for fixed income markets in particular. You're able to now be compensated for owning bonds. You can get 5+ type yield, which is great for lenders who are bond investors or just lenders in general. It's not as great for borrowers. But should we be at a peak in the interest rate cycle, and they don't raise rates again, whether they cut rates this year or next year, things are looking very constructive for fixed income from a current income standpoint, or also a capital appreciation standpoint, because there is an inverse relationship with the price or the value of the bonds that you own to what the prevailing interest rates markets are. So when interest rates go down, your bond values are going to go up, and which would be the reverse of what we had seen in 2022. So long as the rates are high, though, we're very happy to collect that higher level of interest.
And I want to pull up a quick sheet done by Vanguard. It's going on a month or two ago that they released this, but Vanguard is just one of the analysis companies that we use when we're formulating our ideas, thoughts, plans, recommendations, etc. So in reference to what Skylar was saying about the interest rates and the bonds, deciding, hold on, there we go. So this was their projection, their meaning Vanguard, for US bonds from the aggregate side, treasuries, intermediate, high yield, etc. So you can see this return projection that they give a range. And what we like to see is everything is in the black. No red, no negative projections on the bonds moving forward. And that just is kind of the relationship between Jerome Powell probably, or at least from a projection standpoint, not going to increase rates. So we're going to see some, or likely see some capital appreciation on the bond side, which is Vanguard is kind of confirming those numbers, those thoughts from at least the 1 or 2 month ago scenario. And him testifying right now, the markets are up today. They're liking what he's saying. So hopefully we, don't get any huge blips in volatility based on what Jerome Powell is saying. So
Yeah.
That's our hope.
Right.
Well, yeah, I really love that slide actually, because, and if you could pull it back up, that'd be great actually.
Sure can.
Yeah, so if there's going to be and what that is the forecasted nominal before inflation returns for each of the different asset classes. And I think we looked at this last quarter, but it's really good to take a second look here. You have U.S. equities, which have had a tremendous outperformance to international equities over the last decade plus, when they typically U.S. and international trade places and who is the outperformer. And so because we've seen such large outperformance in the U.S., I think that the forward-looking returns are more muted, with an average annualized return of 3.7 to 5.7%, which is a huge difference from what we had seen just over the last decade. So important reminder that past performance is not indicative of future results. Looking in comparison, if you're looking at the global United States developed market or U.S. developed markets, we're looking at a higher forecasted return of 6.9 to 8.9%, with similar volatility than with the U.S. So the weighting to international markets is meaningful to portfolios. Especially forward-looking, in comparing what projected returns might be.
Mm-hmm.
I also really like the look at high yield here, because if you notice that high yield corporate bonds have a 5 to 6% type of return, but the volatility is at 10%. So that's saying is like, hey, you can get a return with almost half the volatility with a high yield position in a fixed income versus in the equity markets as well. So that'd be interesting to see how that will play out.
Yeah, it is. And when we're looking just at bonds in general, you also see a similar thing playing out with emerging markets bonds that are giving a similar return profile to high yield with a similar 10.2% volatility. But when we look at that, we also have to account for the fact that foreign exchange markets play a role in international returns from both a stock and bond standpoint. So even though that might be a 5.4 to 6.4% return, if the US dollar is strong and continues to be strong like it has been, that will be a drag to both international equities and bond market returns. So that's something that we do look at. And another thing I really like about the chart is it's talking about U.S. inflation, 1.9 to 2.9%. If we got that, the Fed would be jumping for joy.
Yeah.
Because
Right.
that is their goal, right? They want to get back to 2%. We're not there yet. The latest CPI is coming out tomorrow, and they're projecting it right around 3 to 3.1%. That is actually an increase from what we've seen from earlier this year. So on top of the last 4 years where we've seen 40 plus inflation numbers, we're still prices are still rising on aggregate.
Right.
We're not getting disinflation. If we got disinflation, then that would be a different story, which means prices are actually falling. And if they were to fall back to where we were back in 2019, that could create some destructive issues from both a wealth building standpoint. Our purchasing power might go up, but if it's because of a recession and people are losing more jobs, and we get to that 5.25 employment rate that the Fed's targeting, that also could create a lot of different pockets of the economy that could break, including banks, which we've seen a lot of news around banks the last 2 years, several banks failing, some already failed this year, and there's projections that some more could. So there are still a lot of cracks in the overall economy that we need to watch, and the recession is really the key. And that's what the Fed's trying to avoid, right? As Skylar said, they want a soft landing instead of a hard landing. But we know that the Fed is notorious for not really getting that soft landing. So we do have to be vigilant and look and see how the economy is doing, how the market's going to react to that, because the markets are forward-looking. They project to what the economy can do in the future and not backward-looking. So the likelihood is the market will see the recession coming beforehand, volatility picks up, and then that could create different buying opportunities in different asset classes. So a little bit later on, we'll show you how the first half of the years went in various asset classes in terms of return, and then talk a little bit more about the future.
Yeah, I think the looking at those inflation numbers is helpful because, and realizing that although inflation is lower, that prices aren't necessarily dropping; they're just not increasing in price as fast. Because deflation would be a real fear, because while it sounds tempting for prices to go down, it's also wages would be dropping along with that. Whereas fixed payments that you might need to make, like a mortgage payment, is going to stay the same. And then so you can get into this real underwater type situation. So lower prices sound great, but it's all tied together.
Yeah, I feel like when you think about disinflation, you're thinking your grocery bill is lower, but it doesn't always. There's some unintended consequences to that too. So, although maybe I would love to get out for a little cheaper than I do now.
I just hope that there's more Honey Nut Cheerios in the box.
Yeah.
The box stays the same, but how much is in that actual bag is decreasing.
Yeah,
So.
that hurts when they've raised the prices and cut what's in there. Yeah.
And that goes to the point of inflation really has hurt companies, supply chain, everything. It's really dragged down both us here because we're paying more, and the companies because they're having to pay more for the supplies that make the ingredients and whatever we buy. So they adjusted for it by shrinking what goes in there while also still raising some prices, and that's a double whammy for us as consumers. So inflation, it's a built-in thing with the system. It is. That's kind of how the monetary system has been since the 70s, once we got off the gold standard. So it's not it's a function of it. It's not an accident. What was an accident is 9+% in inflation a couple of years ago because the Fed was behind the 8 ball in terms of raising rates on time, and we all saw what came out of that.
Yeah, I know one area where prices I don't think are going to be going down with a couple of consumer staples that we have: coffee, chocolate.
Yep.
Weather conditions in all the areas where cocoa and coffee beans are grown have not been great, and so crops have dwindled. And the same thing with orange juice as well. I was reading that orange juice companies are looking whether or not they should incorporate mandarin oranges into the mix because there's just not enough of the, I don't know what they usually use. When I juice, I use navel oranges, but I'm not sure what's exactly in the Tropicana, or I know it tastes a lot different from fresh squeezed.
Yes, it does. Processed foods, the chemicals and everything that goes into our foods, that could be a webinar on in and of itself. So
We'll hire the
Yes.
professional for that.
yes.
Right.
Good. Well,
And
yeah,
I did want to point out that Skylar used juice as a verb.
Mm.
So I did want to point that out because that is a widely used verb now. So
What is it not? Two juice?
welcome to 2024.
there you go. There you
The
go.
Fed has quite the job on its hands. So more to come as early as tomorrow with finishing everything out. So stay tuned and reach out if you have any questions.
Yeah, markets are positive for today in light of the discussions that are going.
That's great. Well, we'll start talking about the markets. What do we want to chat about there? Because there's definitely some stuff going on. There's some big stuff coming up. We know, just a couple short months away, right?
Yep.
Yeah, if I get one more election text message from either side of the aisle, I'm just going to go berserk. I don't know if everybody else has the same, but
I haven't gotten one.
5 or 6 a day, and they're looking for me, or they're looking for Kathleen, which I've had my cell phone number for 20 years now, and they're still looking for Kathleen.
Keep looking.
Yeah, so, the topic of elections and how is that going to impact our investment portfolios comes up every election year, and folks are worried, on how they should react, or if a particular candidate gets into office, what are those implications for markets? And so I know, Nav, you had some charts that from Y charts that kind of illustrate what
I
happens.
do. So let's take a look. Can everybody see my screen okay?
Yes.
Perfect. So the short answer is election cycles really don't affect the market all that much in the long term. And as we look back, this is going very, very long term, 1950 to 2023. This shows a Democratic president and then how the Congress is made up. So a Democratic president with a Democratic Congress, that means both the House and the Senate are majority Democrats, had an 8.72%, while a divided Congress, which means, one Democrat has either House or the Senate and the Republican has one or the other, has the best returns. And that's the case on both sides. So 12.2% under a Republican president, 15.72% under a Democratic president.
Mm-hmm.
So generally speaking, we like having a divided Congress when it comes to markets. Democrat with a Republican led Congress, also the second best returns. Same thing with a Republican. Democrat Republican. Reason being is the markets don't like uncertainty, and when you have a divided Congress, there's less chances of major changing laws that affect a wide scale of things passing. So, and there's generally more compromise. We know we live in a very polarizing political climate, have for a while, and that likely isn't going away, given that we're over $34 trillion in debt. So that's going to be a continual talk. We're spending more than we've ever spent before in our history, more than World War II, World War I, and the Civil War combined has gone out over the last 4 years in government spending. So that's going to be a continued topic to talk about. That's going to change the way the calculus works in a lot of different areas. But regardless of which president is in office and which party is in office, the markets have been positive. So it continues to show that we want to be invested, not based on your political party, but based on the fact that we need to beat inflation so you can keep your purchasing power. And we want your money to be put to good use over time in those companies and bonds and assets that can beat inflation over time.
Yeah, and we also take into consideration, as the listeners all know, what are your liquidity needs? So if you're going to buy another house 2 years from now, we want to know, a car tomorrow, you want to retire yesterday, major changes or spending goals that you have in your life is going to dictate, do we take some money out of the markets and put it on the sideline? Do we change your asset allocation? Has your risk tolerance changed? All of those things are important variables. The presidential election is less important.
Yes. Well said. Well said. This chart just goes through the different levels of the S&P 500, which is again the largest 500 companies in the U.S. based on market capitalization, throughout different presidents' life periods of presidency. You see, generally speaking, it has gone up. We know that there's been pockets of bear markets because that's a normal function of investing in equities because it's volatile. But over time, we see the market overall has gone up. And we expect that to continue moving forward, along with more volatility, because that's a natural risk of investing in the markets.
And looking at the growth since Kennedy was in office is like, I want to say it's awful, but that's the opposite of what I mean. I mean that I'm in awe at looking at it.
Right.
Yeah.
AWE-ful.
Yeah, add the E.
Yeah, it's crazy.
Truly is.
I mean, but it isn't really, it's reality, right?
Mm-hmm. And this is why we always encourage investing early and often. So you can have time in the market, and we don't want to time the market. So that's always a big key. And this is why we don't invest based on political party preferences. So if you were only investing when your preferred party was in power, and say that was the Republicans over this time period, you'd average a 2.8% annual return. That's extremely low. If it was just the Democrats, a little bit better, 5.11%, but still not great. And you can see the value, 77,000, 405,000. But if you just invested overall, regardless of party preference, into the S&P 500, that's an 8.05% return annually. And look at the difference between the value of that portfolio going to 10,000. 3.15 million. So that's just another point of being in the market is more important than timing the market or using your preferred political party as a reason to invest or not to invest.
Yeah.
Yeah, unfortunately, that's a little bit, you can use the word boring, because, the exciting is maybe, hey, let's sell now because I think it's at a high, or hey, let's buy because I think it's at a low, or I don't like the presidential candidate, so let's sell until I like the presidential candidate. That is more action. So you can compare it to stay invested as boring. But the hardest thing that I've seen with clients is not selling, it's when to get back in and to buy.
Yeah.
Because there's always that fear of, oh, well, gas prices are going up, or I don't like that political candidate, or we're heading into a recession, or Jay Powell just said this. When do you feel comfortable to get back in? That's so much harder than actually hitting the sale button.
Yeah.
So stay the course, be boring, and liquidate when you have a need in your financial security, not because you're afraid of something happening.
100%. And talk to your advisor if you're feeling uncomfortable. That's why we purposely have reviews with every single one of you to do check-ins, right? Things change in the economy and the government and your family, all sorts of things. So tons of dynamics at play.
Very well said. So this next chart just looks at what happened under Trump's presidency and now under Biden's, and what has done well, what hasn't. And it's kind of funny that it flip-flops between Trump and Biden. What has done worse? The worst performer was commodities under Trump, and the best performer was commodities under Biden. And the main reason is inflation. So when inflation is high, commodities do better because their prices are rising. We had a pretty low inflation rate under President Trump than we did under President Biden, and that's what the flip-flop is. While we had a very strong growth market because tax cuts happened, companies were borrowing a lot of money because interest rates were so low still. We were still in the 2-3% rate range. So companies could borrow a lot more cheaply to reinvest in the companies. Under Biden, because of inflation, because of what happened with the Fed, interest rates slowed the economy, and companies aren't able to borrow as quickly as possible as they could. And they aren't able to reinvest the same way because everything kind of changed with the calculus of interest rates being at 5% versus 2.
Is that calculus?
Hmm.
I think anything that you were to mention, any of the factors attributing to any of the performance differences between two of markets during each of these presidencies is completely unrelated to who was president.
Correct.
Yeah.
Market forces are much more powerful than who's in office, and that's just the reality.
And actually, a couple of slides back, when we were looking at the value of the S&P 500 dating back to Kennedy, a kind of an interesting observation that I made is that I think during the Nixon presidency is when we moved away from that gold standard for the U.S. dollar.
Mhm.
Yep,
And
right around
I
here.
always hear like tremendous criticism of like, hey, we're a fiat currency and we're not backed by gold. We should have never have done that. But if you look at the growth of companies during up until the Reagan presidency, it was a lot less than what we see now. And I think one of the factors associated with that is the fact that we're not our GDP growth isn't limited to what level of gold that we have.
Right. Yep. Agreed. So that's what we had to say. And overall, regardless of which party was in power, you can see in which president's office, the markets did go up. And that is the key takeaway is investing over time generally gives you a good outcome. And the math bears that out.
I attended an FPA, the Financial Planning Association symposium, and I just pulled this chart. I was kind of digging as Nav was talking here. Can you guys see that?
Yes.
Yeah.
Okay. I thought this was interesting, right? It talked about the S&P annualized rate of changes, and you're looking here, right? This is from ascendwealth.com, a local kind of shop that analyzes stuff. But it was a speaker. He was really captivating. And I thought it was really a great graphic, kind of what Nav was showing, but in a little bit in a bar graph setting, right? But they're almost all positive, just varying degrees. Obviously, George GW had a hard time there. That was a hard one to go through.
Yes.
But
9/11 really kind of hurt his cause.
yeah, I feel like he's an
Capcom,
outlier. Maybe we should take him out for the S&P returns. That was a little out of his control. But it really interesting too. And if you really, critically think about who's in office, which Nav's chart showed, really doesn't matter, right? You have a Democrat here higher than Republican, which is the next, and it kind of switches in and out. So interesting chart too, kind of same thing, different view.
Yeah, so the next piece that we wanted to cover is just a summary of our markets currently. So and Nav, I believe you have the PDF from year to date through June 30th, correct?
That
Yeah,
is correct.
We're halfway through the year and we're halfway through the call, so it's time.
There you go.
That's right. So this is what we call the asset class quilt, and it has the 9 largest asset classes in the world put together as one. And then you can see the asset allocation, which is a combination of all of the asset classes and how that moves. But year to date, we can easily see, hey, large cap stocks are the best performing asset class out of these 9, and that is large cap United States equity. So think SP 500, think Russell 1000, the largest companies in the US by market cap. What is amazing is over 70% of this return is really driven by 10 stocks, which is the largest 10. So when you think about being in an index fund that holds these assets regardless of valuation, whatever it may be, versus an active manager who's trying to beat the market and says, hey, these stocks are more overvalued than I'm comfortable holding, you can see the difference between how an active manager could perform compared to an index. So that is always a consideration with how we manage portfolios. We do both. We have both passive and active. But it would be very easy to see why an active manager, if they don't have NVIDIA, they don't have Apple, they don't have Microsoft, they don't have Google in their portfolio, would clearly underperformed the S&P 500. The second best performing asset class is emerging market equities. And that has been a welcome sign because emerging markets have suffered in terms of performance compared to the US for a long time. And we do think with inflation higher, that tends to benefit emerging market stocks over US and developed markets because more natural commodities come out of those countries, and those companies benefit a little bit more. So not surprising to see EM doing as well as it has, followed by developed markets equities, which is Japan, Europe, those more developed international countries. And then asset allocation, our favorite way of managing money, is fourth best on this list. And again, that's a combination of putting all of these different asset classes together in a portfolio. Depending on your level of risk, it could be higher in equities, could be lower in the fixed income, could be a 60-40, 80-20, whatever it may be. That's going to drive how your account performs overall. But you do that while taking on far less volatility than if you were in just large cap or emerging markets or equities in general. So when we look at the least performing asset class is REITs, real estate investment trusts. And that is a position that invests in different types of real estate. It could be multifamily housing apartments, single family homes, commercial real estate. So far this year, that has been the worst performer. We're starting to see more defaults in both commercial properties, selling for far less than what they were valued at 10 years ago, 5 years ago, even 3 years ago. And we've seen more multifamily housing coming on the market, affecting rents. So there's a whole lot of different things coming on, but we know over time, REITs are one of the best performing asset classes. So even though it's a struggle this year, we do believe in real estate long term, and then fixed income is the second lowest performing. And that's kind of been the theme over the last few years. Like Skylar said earlier, because interest rates have risen, and when interest rates rise, bond prices fall. Not the yield you get, but the price of the bond itself. And that's what this is showing.
Yeah. I mean, if you look back to 2021, 41% return, even after a 24% loss or almost 25% loss in 2022, we're still, and then again, positive in 2023, it's still been a great investment.
Absolutely.
And this also, pointing to some of the commentary made earlier between U.S. and international performance, you can see over time that international, like in 2009, even in 2010, emerging markets outperformed U.S. large cap, but not developed did not. But back and forth, you'll see that international holdings outperformed the United States.
Right.
They have not been able to keep up over this time period since 2009. They've had about half the return.
Yes.
So this is the opposite of what the forward projections that we looked at from Vanguard are showing.
Right. And when you look at the 09 to 2023, we love this part because it gives more of a clear picture of, hey, what's really happened. Large cap stocks in the U.S. have been the best, and the volatility, so the rate of movement between prices is right in the middle, down at 16%. So if we had a crystal ball and we could go back, we'd say by far U.S. large caps the best place to invest. We don't have a crystal ball. We can't do that. And just like we don't have a crystal ball for the future, so we're going to stay invested in all of these different asset classes. But when you look at asset allocation, 8.1% with the volatility third lowest on this list, but the return is high middle. So that's the key is staying invested, staying disciplined, not selling out of unless something has changed in your financial situation, not outside forces, but you need money to buy a house, whatever it may be, like Greg mentioned. Staying the course has paid off over time. We've always go ahead, Sky.
I was going to say, and the recommendation is if you need money to buy a house, then don't have that money invested.
Yeah.
That's going to be your conservative, that's going to be your cash position, because your time horizon and your liquidity needs are one of the number one factors driving what your asset allocation is and where you hold it. So that, home purchasers got to put that money aside. Although you could take the risk and you could have a favorable outcome, but you might not as well. You still need
Especially with cash paying as high as it is now, a lot of times it's best to put in a high yield savings account or buy a CD that matches up with that time frame for when you're looking to buy that house. So there's a lot of different options for where to put money for short term. Long term, it's the markets, it's assets. Short term, it could be more of a high yield savings account or CDs.
Okay. Anything else on our talent chart quilt?
I think Nav did an excellent job. Thank you very much for going through all that.
Absolutely.
Well, if you guys have any questions on the markets or anything, markets, interest rates, reach out to your advisor. We'll talk about it later, but we are going to send a scheduling link out tomorrow in the thank you email. So it should be easy to get on everybody's calendars for that. Any other big planning topics that we wanted to talk about today before we move on to some housekeeping items?
Tax returns. If folks have, I know that we are, a lot of people filed for taxes in April, and we have already received a number of our clients' tax returns. We have sent them in for our review. We do try and incorporate your after-tax return, so having a better understanding of what your taxes are, help with the investment management side of things, but also on the planning side. So if you have not sent in your tax return to us already, please do so. I know Nav and I will be following up with folks, making a request. Although people are still on extension, I know as well.
And a good way to submit them, as a reminder, I wanted to go through the Wealth Vision Vault, kind of as an exercise for clients on the call and as it gets redistributed. Really helpful tool here. Not only can you see your whole financial picture, which is a great reminder in itself and refresher, there also is a vault function where you can upload documents and we can see them. So that's great too for even your legal documents. But in the case of a tax return, it avoids having to securely mail them or worse, unsecurely mailing them. And same with email, right? Hopefully securely emailing them. We can send you a secure link that will encrypt it back to us. I hope you don't roll the dice and send them unsecured, but there's that route too. This Wealth Vision Vault prevents all of that. You can log into your account view and then go into your Wealth Vision portal. And when you're there, it will look just like this. This is a sample client. They're not doing too bad. For $40,000 cash and a $2.6 million net worth. But you'll sneak right up here in the vault. You will go into the shared documents folder, and then we'll be able to see whatever's in here. You can hit upload files or folder and then be able to attach that. So that's going to be a super secure, easy way without running into secure email issues or too large of file issues, which that happens too in the secure emails expiring. We get a ton of frustration from that, both sides, because we want it to be a nice experience for you. If you have questions on that, let us know. We'd love to send a demo out. We might even include that in the tax email too. And if you haven't sent your tax returns, now you know how.
Yeah.
One more. Go ahead,
Greg.
No, go ahead. I was going to switch topics.
To get to Wealth Vision, it's just going to your myaccountviewonline.com, log in, and then there's a button that says Wealth Vision on the site, and it will take you right to that portal.
Yep. Greg, you're up.
I believe I mentioned this last quarterly webinar we had, but estate tax legislation is either lack of or new legislation is a common topic. If you're reading or listening to financial news, there's a lot of commentary going around. The major I guess, topic or reference point is the fact that estate tax laws are going to sunset on January 1st of 2026. And if no legislation is passed, either extending the current tax laws or changing the current tax laws, everything is going to revert back to where it was. And that is basically bringing down, as it pertains to estate tax planning, it brings down the unified credit amount. So one of the topics that we are going to consistently have on all of our client agendas, any gifting that wants to be done on the trust side. Do you want to use annual exclusion? Do you want to use unified credit? So just be aware that this is going to be a topic. We'll bring it up. It's on the news on whether it applies to your family situation at all, because there's a lot of different variables that go into whether or not you should gift. But now's the time to talk about it.
Yeah. And there's more to that TCGA that's sunsetting too. It's not just estate tax, although that's obviously predominantly the massive topic, especially for some of our client base, but there's some other stuff too, that could affect you. So definitely inquire.
It's such a wonderful use of language to call an expiration of tax changes, to call it a sunset.
I know. Doesn't it sound so pretty when you say it like that?
It sounds great. It's a sunset. I love watching the sunset, but it's really is hey, these tax benefits are going to end, but they can't sunset.
It's getting dark. Sunset means it's getting dark outside.
Now that you put it like that, I'm a little concerned and scared.
There you go.
So, you gotta love it.
Good. Well, we have a short one today. It's summer. We didn't want to keep you on for too long. We anticipate the October one with the election right around the corner being chock full. So we'll make up for it then for you. But we really appreciate it. Two quick housekeeping notes as we close out. Save the date. We have our fall festival coming up Saturday, October 5th. We're going to be doing that at Lone Oak Brewery in Olney. It's a great spot. Tons of activities to do. We're going to have a pavilion, so it's covered. Will be a rain or shine event. I believe we're starting at 11 and we'll have a catered lunch there. There's also obviously beer. I believe they have cocktails too. I think they started a distillery. So wonderful space. And then feel free to bring your kids, grandkids, friends. It's a one come all event. We'd love to meet them, talk to them, enjoy themselves. If there's young kids involved, there's small playground and stuff for a little bit of bigger kids. So we're excited to see you and your families. We did a similar event at Manor Hill last year, and it was a really great time. So we hope to see you and your family there. And then,
don't undersell it. You forgot to mention that there's going to be live music.
Yeah, yes, there will be some live music. Yes.
And I don't know that this is going to be there this year, but when I was there last year, there was a pneumatic pumpkin chunkin cannon, and you could purchase pumpkins to shoot from it, which was very entertaining to watch or to shoot. So I'm hopeful that that'll be there. That'll be there again.
Is that your special request?
Hey, look, it's cool.
Tis the season. I know it feels weird to think that in 3 months we'll have had that event and we'll be like prepping for Halloween. As we're in like a massive heat wave and you're suffocated in the humidity walking outside. Really. Then just another quick friendly reminder. Most of you probably have met Julie and or Rena. They're both new to our operation staff, fairly new, I should say. Rena started with us in January and Julie in April. So we're really excited to have them on the team. Julie's our new operations manager. She's lovely. And Rena's just an operations team member. She's going to be you'll see her name a lot when you're getting maybe some paperwork, stuff like that. So if you're seeing that on your DocuSigns or Adobe Signs, that's where you'll likely see her name. If you haven't met them, say hi. They're both on our website. You can learn more about them, see their picture and their friendly faces. But just a friendly reminder, some staff changes since you'll be hearing from them. Greg, Nav, Sky, anything I missed? What do we have left?
I think that's it. Thank you very much, Katie. Thank you, Greg. Thank you, Nav. Appreciate jumping on the call. It's always great to catch up with you about the markets and financial planning topics.
Yeah, great time as always. Appreciate it, guys.
Yeah, no problem. Thank you guys so much for coming. I think I mentioned this. We will be having our thank you email go out tomorrow with scheduling links to everybody's calendar. We're so thankful you stayed on today and joined us. Thank you for your commitment to our firm. We love you guys.
Thank you all.
Happy summer.
Bye.